Hey everybody. Hope everybody's been having a good day. Just going through a couple things. Once again, I've been in and out of town, in and out of many places. It sounds funny, but if you need me, email me. But right now I'm just in the middle of doing a bunch of shit. Doing what I'm supposed to be doing. So email me if you need me. All right. So, anyways, jumping right into this, we definitely have some interesting things, and I just kind of wanted to go over a couple extra things. And now that I'm able to, I'm going to be posting a bit more. So be ready for that if you'd like. If not, fuck you and fuck me too. All right. So looking at this and the markets, so far this year to date has been quite interesting, which we've definitely had kind of what I was looking for more to happen at towards the end of the year has started to happen now, which is very usual. Sometimes you will always run into things in trading that, you're either early or late. Like that's the thing. You're never perfectly on time. That has to become okay with you because that's just the fucking name of the game. Figuring out how to survive through that is the important part. You survive, you lose small during that period, you make big money when you're right, little money when you're wrong. You end up doing well in the long run, and that's what's important. So, and basically protecting your capital. Small drawdowns are easy to live through. Big drawdowns are not so easy to live through. So, if your capital goes down by 80%, you're going to have some fucking trouble. Your capital drops, like quite less than like half of that, you're doing a little bit better, and even less than that, even better. So basically preserve capital and continue to make the right moves over and over again, and you'll do all right. So basically what we're looking at here, and also diversifying, your investments. If you're only invested in one thing, you want to be diversified, so you're in many areas. We talk about it before, having money in, like, for me, I have commercial real estate, I have businesses I invest in, I have random, gold and silver, I have real estate that's not commercial. You go down the line and you kind of create different things. You get a retirement portfolio over here, you have a futures portfolio that's your volatile crazy investment over here. Maybe a little bit of crypto, maybe some, if you have some other plans. Those you get riskier and riskier, you make that smaller and smaller, and basically that's a good recipe for longevity in investments. And honestly, that's a very short way of it's a very long story short way of answering that. So definitely look into that, take your time, research all of that, and you'll do well in the long run. Anyways, getting into what I do. So going into the markets, looking at the sectors, we still see the market is very in a risk on part of the market. Risk on meaning we're seeing the XLV, which is healthcare. We're seeing XLP, consumer staples. We're seeing XLU, which is utilities. All of these are just kind of in this defensive. Those are the defensive sectors. Basically, you'll see those start to do well when everybody's running away from everything else. Why? Well, consumer staples, they're trusted companies, been around for fucking ever. Healthcare, same type of thing, but also, these can do well in those type of environments. Nothing's recession proof, but you get paid a yield. Same with utilities. Most of the time when bonds are doing well, utilities do well. Flight to safety, basically, in all three of those sectors. What we're seeing though is that tech is starting to lead again. XLC, I kind of consider that tech. That's mainly driven by Google. XLY, mainly driven by Amazon. XLK, mainly Microsoft and Apple. So we're seeing a lot of tech kind of taking over to start the year, which is a good sign. Do I know if that's going to last? I'm not sure. It's not, my relative strength signal is not saying that tech is the greatest area to be in. However, I do like emerging markets. Emerging markets have a lot of tech in it as well, but it's a little bit diversified away from the U.S. tech industries. You'll have things like Alibaba and so on in there, which have been hammered in the last couple of years, and these things have done pretty terribly. But now, kind of looking this direction, they're kind of moving up. They're kind of doing well. Over the last 3 months, we'll see that emerging markets is leading the way, followed by materials, real estate, and industrials. So I like the way that all of it, and financials. So I like the way all of these are kind of looking right now. These are kind of saying a lot about where the market could head and will head. In the last 6 months, see that energy has still led the way. It's held up the best. I think a lot of people, the hype on it is so much behind oil, basically, and oil isn't doing badly. It's just kind of stuck in the same kind of zone, and so is XLE. So they're kind of stuck in the same zone. Still like energy, still think energy stocks are somewhere where you want to be. So a great place to still put your money. But there's other things that are starting to look up as well. But if we look over the long run, tech is still not really holding up as well as we'd like to. Get very bullish on it, but emerging markets, which is another way to play that, I would definitely be interested in using that for now. But year to date, we're still seeing this kind of risk off. Risk off is dead. Risk on is on. That's kind of what we want to see. That's exactly what we'd like to see to say that this market rally finally has some legs in it and could take the market up a little bit higher. We have to remember the S&P is so driven by tech. It's heavily invested in tech stocks. So as long as that's the case, we need to see tech move up for the rest of the market to move up. But also that tells us something about bonds. That says that yield should be dropping, which also says that inflation. Now, I'm not talking about all the commodities. I'm not saying that all commodities are dead. I'm saying that inflation, as you know, the Fed will be reading it, should start to come down, and prices of bonds should start to move up. We like some of these bonds right now, especially we like long duration bonds, short duration bonds, basically anything bonds, which is funny because it's been many years where I've definitely have said the opposite. I've been short the bond market since mid 2020. So now that we're looking at it the other way, could that be a bad trade? I don't know yet. So far, so good. It's been a phenomenal trade. It's been going the right direction for a while. I think that's going to hold up. I think the market is telling us that as well. As you can see, yields are still high historically, but that could be coming down, and that could tell us something about the market. Mainly what I want to go over was a couple quick things today. Bitcoin being one of them. Bitcoin comes off of these major squeeze patterns. Squeeze, pop there, squeeze. So this is Bollinger Band squeeze. And so this basically tells us the width of a Bollinger Band. Bollinger Band measures the volatility of a product. But through standard deviation. So basically, as this is tight, as the bands are tight, meaning the price isn't moving up or down very much, it's right here. It's on this lower end. And when the price is moving too much and the bands are getting wider and wider and the standard deviations are growing, we see that that's moving to the upside. So a quick understanding of, I hope I said that right. I'm not sure if I said that right. No, double check me if you need to. But basically trying to explain Bollinger Bands in a nutshell. We saw the similar thing here. That did bounce. Then all the FTX and every fucking other thing else happened. All the cryptocurrencies got hammered, and then we went back into another squeeze pattern, which is an even tighter squeeze pattern than we saw before. And now we're moving back to the upside, sustaining over the 200-day moving average and moving higher. I still am bullish on crypto now. I still, as of the last video I talked about it, still think it's got more to run. Nothing's telling me that this is looking bad, so still like crypto for the moment. And as we're seeing here, so crypto, this is Bitcoin against the S&P 500. You see these kind of run together, but it's also because that crypto really leads the market. Most of the time, crypto is mainly leading the market. So here we are moving back to the upside, crypto leading the market, and we'll see where that ends up. Okay. Now we're getting to cotton. And so talking about cotton, so some of these commodities are looking really interesting. And this kind of same type of situation we have, this is a weekly, so we're not going to see squeezes as tight as we saw over there. We're seeing a squeeze pattern on cotton. We're kind of seeing this consolidation. I love when these consolidations happen. So basically, we'd want to be buying over this zone here, looking for kind of a breakout of all this pattern. I like the way this is looking. I certainly like the COT report. COT data is really telling us something as well. There's a lot of interest in cotton. Cotton is getting bought up like crazy here in the commercial market, with China doing its back and forth and trying to come back online and not trying to come back online and shutting down and opening up. This looks like if that does happen, cotton could be one of the beneficiaries of that. So I'd want to keep an eye on it, wait for that breakout, and definitely pounce on it if it does happen. Coffee looks fantastic. This is a major buy signal in the COT. Now this isn't, we don't just take one thing and go, okay, we got to buy this right now, forever and ever and ever. We look at this and go, okay, this is one ingredient in this buy signal. So looking at coffee, I like the way this looks. That's telling us like one piece of evidence that this could move higher. And now if we look at the chart on the weekly, we're seeing another one. We're trying to get up and over this 10 on this EMA here. That would be a good signal that we haven't seen for a long time in coffee. But what I like the most about coffee right now, let me get a little bit closer here, is this false breakdown pattern. Nothing excites me more than a false breakdown pattern in the market. So meaning we create these lows, we break past these lows as we did, and then we reverse higher, get back above that, and this continue. This looks great. This looks like a buy. You basically, what you do with these type of patterns, you buy this here, you put a stop under these lows here, a trailing stop, and then continue following it up. You could do a bunch of different ways of putting your stop loss. Some people do trailing stop using ATR. Some people do the lowest low the last 4 days, last 8 days, last 5 days, whatever you back test and come up with. But this could definitely be a way to see coffee move higher. Now, lumber is another one, and this is important because it covers many markets. So really like lumber here. Really think that it's telling us something as well. Looks very much like Bitcoin's chart, really. And that makes a lot of sense considering lumber kind of shows you when the market's going into a risk on mode, risk off mode. Risk on meaning it's moving higher. And also Bitcoin does as well. So we're seeing that we do have that buy signal generated from the price channels, Donchian channels, whatever you want to call them, moving higher here, breaking out to the upside. It's even higher today. I think it's limit up today as well. A lot of volume pushing in, divergence in volume. Even though that's futures, that still is an important signal. Relative strength is moving higher as well. So that's also a good signal. Going through everything else, like things we went over lately, things like gold, silver, platinum. Gold speaks for itself. It's been really trending up higher. It looks really good. I really like the way gold looks here. Really want to stay long. Really the right environment for gold is when you come out of those huge yield curve inversions, which we're in right now. We're in a yield curve inversion. We're coming out of it. I think that's what my mind is telling me. That's what my research is telling me. So, in my experience, there could be somebody who feels differently, but that's what my experience is telling me. That doesn't mean that the Fed's doing blank or whatever. That means that the yield curve, whatever the Fed is doing, I think that the yield curve will start to spread out again and won't be as inverted, however this goes right now. And most of the time, gold likes that environment. Gold likes when real yields are falling. So that could be an environment where we're seeing a lot of upside in the gold market, silver market, platinum market, and so on. But this is a strong trend. This is moving higher quickly. I think we'll be in the 2000 range soon enough. And then we can make an assessment from there. But we have to remember that 2000, there's going to be pretty strong psychological resistance. Those even numbers, it isn't that there's resistance there and be careful because it's not even numbers are stupid. There's nothing that needs to happen in an even number. That's what people predict. I predict the price of gold is going to hit 2,000. Like, yeah, even numbers, but at the same time, there is a possibility of it hitting somewhere around that zone and people looking at it and going 2,000. I remember 2,000, just like they did a few years ago when they said, "Oh, I remember 2000. I remember when that happened. The price hit that 2000 to 2,500 zone." Let's go back to weekly. It's not pretty. Chart. And people went, "Oh yeah, I remember when it did that back in." You know what? Let's just go all the way through this, because this is what happened last time, and it's important to talk about this. So, as you see, the price hit up to this zone, and the same kind of thing happened. It got above it, and then it dropped again. And that usually happens. You'll see that price will break over an old high. A lot of people, there's people who bought here and held, for years and years and or sold down here or whatever, and they remember when gold got to this zone again. And most of the new people, they'll get in and they'll jump in, and then you get these sell-offs in it because a lot of people are also doing the opposite. And then you see that sell-off, and then it'll reverse and try to move higher at some point later. And I think the same thing kind of happened here. You got all those people in 08 to 2010 ended up buying when there was a gold rush fever. If you were around for then, it was fucking crazy. See, gold rush, everybody goes, "Oh my God, I got to get into gold." And then it drops down. They usually sell here or they hold it the whole time. And then when it breaks up again, they remember, "Oh God, I remember when gold was, around this zone last time," and then it falls down. So we're going to have that psychological level of 2000. Really, that any zone between 2000, 2150, somewhere around then, I'd be aware of and keep an eye on right now. But really, I think we can at least run to 2000 pretty easily. I think we can make it there. All right, everybody. Hope everybody's had a good week. We'll talk soon.